Take a look at the net profit chart of Bharti Airtel since 2002 when the company was listed on the Indian Stock Exchange. Between 2004 and 2010, the company's profit shot up from 585 crores to 9,306 crore, a massive 16-fold rise in just 6 years. But by 2013, its profit had fallen to about 2,200 crores. They again rose to about 6,800 crores in 2016 and then started falling after that, hitting 1,600 crores in 2019. The COVID-19 shock and exceptional items marred year 2020 and 2021, so the company booked massive losses. However, between 2022 and 2024, the company smartly returned to profitability and seems to be on track of regaining its lost mojo. Bharti Airtel's roller coaster journey exemplifies the importance of analyzing economic moats in investing. But if you're not sure about what an economic moat is, don't worry. That's what we are going to discuss in this video. Hello and welcome to ET Money's YouTube channel. Warren Buffett said that the most important thing in evaluating businesses is figuring it out how big the moat is around the business. So, as a stock investor, you can't afford to underestimate the importance of analyzing economic moats, and that's what makes this video indispensable. Now, this video belongs to our playlist of how to pick stocks. If you want to watch more such videos, check it out. The link is in the description. Okay, let's first begin with understanding the concept of moats. Let's first see what a moat generally is. Now, the dictionary meaning of word moat is a long, wide hole that is dug all the way around a place such as a castle and usually filled with water, making it more difficult to attack. Now, this should make the idea of economic moat clear to you. Like a moat around a castle, an economic moat around a business makes it difficult for competitors to encroach into the business's territory. Thus, in turn, means not just high profits, but also sustainable profits. This brings us back to Bharti Airtel's example, which we saw at the start of this video. Bharti Airtel is a pioneer of Indian telecom. The company started operations in 1995. As Indians adopted cellular telephony, the company's profits grew rapidly between 2002 and 2010. Until this period, competition in the sector was limited and there was ample room for growth and expansion as the penetration of cellular telephony was quite low in the country. However, things started to change after 2010. Due to the booming profits, many other companies entered the telecom sector. By 2014, there were as many as 13 players in the Indian telecom sector. Now, this intense competition resulted in a drop in Airtel's profit between 2011 and 2013. However, as price wars resulted in sectoral consolidation, Airtel's profits rose again until 2016. But then came Reliance Jio, which disrupted the sector by bundling voice and data services and offered services virtually for free to acquire market share. As a result, Airtel's profits again slumped. However, post the COVID-19 shock, only 3 major telecom operators remained in the country: Airtel, Reliance Jio and Vodafone Idea, rechristened as Vi. Now, Vi's survival looked uncertain as the company was saddled with high debt and government dues. Now, Vi's poor situation ultimately benefited the remaining 2 players, Reliance Jio and Airtel. This shows in Airtel's recent surging profits too. Now, what does Airtel's case tell us about the importance of an economic moat? Well, rising profits in a sector invariably attract competition. As competitors vie for market share, the profitability of the sector's companies is impacted. To protect its profits from competition, the company needs a moat, like a moat around a castle, so that competitors cannot encroach on its space. In business lingo, a moat translates into competitive advantages and barriers to entry. Companies that maintain their moats for long periods can maintain their profitability for an extended period, which tends to translate into superior stock returns too. And this is why the concept of moat lies at the heart of intelligent stock investing. So, while it's good to check metrics like revenue and profit growth, return ratios, and cash flows when researching a stock, it's even more important to check if the company possesses a credible moat. In the absence of a moat, or if the moat is weak, good performance can falter anytime. Checking the presence and strength of moat is even more critical if you're looking for stocks for the long term. But how does one go about finding stocks that have a strong moat? That requires you to combine quantitative and qualitative analysis. Let me explain why. To find companies with a credible moat, you will need to combine quantitative analysis with qualitative judgment. Neither is sufficient to identify companies with a moat on its own reliably. That's because they can send wrong signals. Bharti Airtel's profits grew at 59% per annum between 2004 and 2010. Looking at the profits alone would have made one feel the company possessed a strong moat. But when the competition increased, the company's profits slumped for many years. They were hit for the second time after the entry of Reliance Jio. Now, this suggests that the moat wasn't as strong as one thought. Similarly, a low growth company may look unattractive, but if it can maintain its pole position amid competition, that may signal a moat. A case in point is Hindustan Unilever. The company's profits have grown by just 10% per annum over the last 10 years. But thanks to its powerful brands, the company continues to be the leader in the Indian FMCG pack. Its stocks have commanded a median P valuation of about 60 times over the last 10 years. Of course, HUL's industry also a role in this. Consumer staples is a resilient industry that is less impacted by economic cycles. Similarly, subjectivity alone may not suffice to identify a moat. Even if you have identified a company that possesses a moat, that moat should also translate into sustainable profits. An example here could be Interglobe Aviation. With a market share of 65% in January 2025 and a low cost advantage, it's easy to assume that the company has a moat. However, given the nature of Interglobe's industry, staying consistently profitable is difficult. Of the last 10 years, Interglobe reported a net loss in 4. Of course, there are COVID-19 years in the set, but the company's profits have also shown high fluctuations given the nature of its business. Now, the cases of HUL Interglobe suggest an important determinant of the company's moat strength, the industry in which it operates. A company can be an outlier in its industry or better than its peers, but it's not often immune to the industry's vagaries. So while evaluating the strength of the moat, it makes sense to also consider the overall industry. Overall, moats and their strengths should be assessed holistically, considering both the quantitative and qualitative aspects. Now, a useful way of doing so is what we will discuss in the next section. In his book, 5 Rules for Successful Stock Investing, Pat Dorsey discusses how you can go about finding companies with a moat. Dorsey was a director of equity research at Morningstar between 2010 and 2011. He now runs his own asset management company, Dorsey Asset Management. His 4-point approach combines the quantitative as well as the qualitative aspects of researching for moats. The 4 legs of his approach are: first, evaluate the firm's historical profitability; second, find out why the company is able to keep competitors at bay and protect its profits; third, estimate it for how long it can continue to do so; and fourth, analyze the industry's competitive structure. Of these 4 points, the first is quantitative and the other 3 are qualitative. To assess a company's historical profitability, Dorsey suggests using a combination of 4 metrics. First, free cash flow to sales of 5% or more. Second, net margins of 15% or more. Third, return on equity or ROE of 15% or more. And fourth, a return on assets or ROA of 6 or 7%. Now, Dorsey also gives the rationale for these criteria. Free cash flows are obtained by reducing capex or capital expenditure from operating cash flows. Companies that have free cash flows have excess cash left over after reinvesting. In other words, free cash flow is the money that can be extracted from a business without damaging its core operations. So, free cash flows are a proxy for business strength and quality. Next comes net margin. Net margin is net margin as a percentage of sales. Now, this tells you how much profit a company generates for every rupee of sales. The higher the net margins, the better. Dorsey took the minimum as 15%. Then comes return on equity or ROE. ROE is net income as a percentage of equity. ROE measures a company's profitability in terms of its equity. The higher, the better. Dorsey considered the cutoff as 15%. And lastly is ROA or return on assets. ROA is net income as a percentage of assets. It tells us how efficiently a company generates profits from its assets. Now, these metrics should be checked not just for 1 year, but for multiple years to ensure consistency. Dorsey admitted that the cutoff values are rule of thumbs and not hard and fast rules. Comparing firms with industry averages is a good idea. Now, the trend in these profitability metrics matter too in terms of whether they're going higher or lower. Now, we applied Dorsey's criteria on non-BFSI stocks within the BSE 500 and checked the data for the last 5 years. For each of the last 5 years, the condition on your screen should be true. Free cash flow of sales of at least 5%, net margin of at least 15%, ROE of at least 15%, and ROA of at least 7%. Now, this gave us 22 stocks, the names of which are on your screen. Now, it may be tempting to consider this as a final list and buy the stocks, but that would be a mistake. Unless we apply a subjective, qualitative layer on this list, we can't be sure whether these companies have a credible moat. Okay, let's discuss the qualitative criteria in detail in the next section. But before I start on that, if you're finding this video useful, do subscribe to our channel and don't forget to press the bell icon so you never miss a video from us. Qualitative assessment of moats involves asking what may be responsible for a company's moat. Asking this is important because by doing so, you can determine how sustainable that moat is. Now, Dorsey advises trying to figure out how deep and wide the moat is. Depth refers to how much money the company makes due to its moat, and width refers to how long it can continue to do so. Often, technology companies have deep moats, but they are narrow. On the other hand, an FMCG company like HUL may not have very deep moats, but they are quite wide. Some of the common reasons for a company's moat are a differentiated product or service, low-cost advantage, brand strength, wide distribution, high switching costs, that is, it's difficult to switch to an alternative product or service, regulations, patents and licenses, long gestation periods, network effect, that is, the larger the number of customers who use a particular product or service, the more appealing that product or service becomes to even more customers. Now let's assess Bajaj Auto, a company that appears in a list of 22 companies with a moat. Now Bajaj Auto derives its moat from a low cost advantage, brand strength and a wide distribution network. The company's low cost advantage is reflected in its superior operating margin as compared to its peers. The Bajaj brand needs no introduction and the jingle of Hamara Bajaj is still fresh in the minds of many Indians. Now, Bajaj Auto claims to have sold over 1.8 crore motorcycles in 70 countries. It is India's #1 motorcycle exporter, which sells 2 out of 3 bikes sold internationally. It is the world's largest manufacturer of 3-wheelers. All these work as credible moats for the company. But how sustainable are these? Well, quite a lot. It's not possible for a competitor to overnight build a brand like Bajaj, replicate its distribution prowess, or establish a robust supply chain to control costs. But what about the auto sector, especially the two-wheeler industry? Well, the sector is undergoing a transformation due to the rising popularity of EVs and electric two-wheelers. But a look at Ola Electric's rising losses suggests the electric two-wheeler leader is still far from turning the sectoral tailwinds into real money. Ola Electric is also mired in a number of controversies around consumer complaints and its sales numbers. And it's not that Bajaj Auto is oblivious of the rise of EVs. The company's Chetak EV has been registering triple-digit growth over the last 3 years. As far as electric 3-wheelers are concerned, the company has already cornered a 12% market share in FY24 from 0 in FY23. As a matter of fact, given the strong financial position of Bajaj Auto, coupled with its decade of experience in the auto industry, it would be easier for the company to pivot to EVs and electric two-wheelers in the future if required. Now, this simple qualitative analysis suggests that Bajaj Auto's moat is durable. Now you can do a similar analysis for the rest of the companies in the table to check the depth and width of their moats. Okay, let's conclude this video by taking a look at some other important aspects of economic moats. Analyzing the economic moat is the cornerstone of intelligent stock investing. Doing so helps assess whether a company's profitability will be maintained or not in the foreseeable future. Now, this is especially important for long-term stock investing. However, it is also important to realize that the assessment of economic moats is not an exact science. While we have discussed a way of doing so, by no means it is the only path. There can be many companies that haven't appeared in a list but have a credible moat. And there can be companies that have appeared in a list but don't have a reliable moats. But one thing is clear, while analyzing moats, combine quantitative and qualitative aspects. Don't rely on either alone. Now, when you start analyzing moats, it's useful to keep a few things in mind. First, moats may not be permanent. While they can last for many years, economic, social and cultural undercurrents can change the way business happens. For instance, Intel enjoyed a wide moat for many years, but the company missed the mobile computing revolution. It later fell behind in the race for GPUs or graphic processing units and AI-enabled chips. This enabled its rival Nvidia and AMD to overtake Intel. Second, moats can have a varying degree of strength, and this degree can change with time as well, either upwards or downwards. So a company that enjoys a strong moat today may have a weak moat a few years hence and vice versa. So it's a good idea to segment the moats of the companies you study into strong, medium, and weak to gain a better perspective. Third, while the assessment and analysis of moats is not an exact science, it should be done nevertheless. Not analyzing economic moats can be worse mistake than wrongly analyzing moats. And last but not the least, like valuations, analysis of moats can also be colored by investors' subjectivity. This is only natural as qualitative analysis is an important element of assessment of moats. For example, one can argue that Bharti Airtel must have possessed some moat because it has been able to survive the storm in the Indian telecom sector while many others fell to the sector's brutal dynamics. Moreover, the massive sums required for buying telecom spectrums would act as a natural barriers to entry, and with no new competitor in sight, the incumbent telecos have a lush green field in front of them for years to come. Now, all these factors can make the analysis of economic moats tricky yet interesting. And like many other professions, you gain an edge only with experience. And with this, I've come to the end of this video. I hope you found it useful. And if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.